Just in time. Yes.
Just in time, huh?
We are all live. We are live now. So
We thought you're still celebrating Labor Day.
No.
Okay, good to see you here, huh? Good to see you, Sarah, as well. I can see you found a room for yourself.
I found a room.
Oh, yeah.
Crisis averted.
Yes, good.
You guys weren't really worried about me, were you?
I was honestly like not bothered.
Probably better without me, to be honest.
Good, we are live. I can see 40 participants already with us. Good evening, everyone. Welcome to the Marsh webinar on cyber insurance, emerging threats and market overview. It's 5:59. We'll start in a minute or two. Good evening, everyone. Welcome to the Marsh webinar on cyber insurance, emerging threats, and the market overview. We have a power-packed panel today with us. I'm sure it's going to be a good investment of your time. I can see the attendees list going up steadily. It's 6:06 p.m. If you allow, we'll just take another 30 seconds for people to fill in, and we'll start. Good evening. Our attendees list is steadily going up. I think we should kick off. Welcome everyone once again to the Marsh webinar on cyber insurance, emerging threats, and the market overview. Like I promised, we have a power-packed panel. We have Tom joining us from USA. We have Sarah joining us from London at this point in time. We have Bhishma, who's our India leader for cyber, joining us from Mumbai. My name is Anup. I'm going to be your host for today. And like I said, it's going to be a good investment of your time on the cyber trends and the market overview. Let's roll. So a bit of housekeeping on the Q&A side. You may type your questions in the Q&A tab. You'll see it at the at the bottom of the screen. Anytime during the webinar, someone or the other will try to attend the question at that point of time. If you'd like to speak, please raise your hand. We'll be conducting some dipstick polls. Feel free, these polls are all anonymous. They're all aggregated. And we are not going to identify who said what, but we would like to hear your voice virtually on this one. Like I mentioned, we have Sarah Stephens. She's the managing director. She's also the head of our cyber business internationally. We have Tom Reagan, who's the managing director and the cyber practice leader for us in USA. We have Bhishma, who's the cyber practice leader for us in India. So a lot of cyber power-packed panel today. And my name is Anup. I'm going to be your host for today. I have the privilege of leading FinPro, which is specialty lines, as well as BMA in India, private equity and M&A in India. Good. So you must have seen this thing floating on WhatsApp forwards and LinkedIn, that who led your digital transformation of the company, your CEO, CTO of COVID-19. I think everyone agrees that the pandemic, apart from creating a lot of turmoil, has also been a huge accelerator for the digital adoption by different companies. By some statistics, it's actually accelerated digital adoption by old school companies by 5 years, maybe more. But what has also happened is, along with the cyber issues, we also have a huge amount of cybersecurity threats which have come in, because when you deliver services, when you reach out to your customers digitally, you also open up yourself to cyber exposures. So next one, please. I'm going to ask you a question that this is what we feel, but what do you think is your firm's most crucial risk? Super. So 71% of the people feel that it's cyber attacks, and 19% of the people feel that it's continued fallout of the COVID-19 pandemic, or it could be another pandemic, right? Who knows? So I think we've done a good job in priming you mentally with this cyber talk. I'm going to hand it over to Sarah right now. She's going to talk about what we're seeing across the world and some of the big trends. Sarah, over to you.
Thanks, Anup. If we just go ahead and build this whole slide, then we can kind of talk through some of the key challenges that have been driving the global cyber market. And if you've renewed your cyber insurance recently, or you've tried to purchase a new cyber insurance policy, you know that it's tough out there. And what we really started seeing globally is, starting in the fourth quarter of 2019, we began to see the effects of real diversification in criminal strategies around ransomware translate into both an increase in the frequency and severity of ransomware incidents in the insurance market. And we saw, a real shift for cyber insurers who typically had dealt with lots of big data breach claims. And, ransomware was a small part of coverage. We had cyber extortion as one insuring agreement, but typically those claims were small, they were dealt with quickly, and they didn't lead to major business interruption incidents. And the big change that we've experienced in the way those claims play out for insurers is not only sometimes are the expenses much larger, the demands much larger when they're actually paid, but also we have significant follow-on business interruption. And while that sort of trend in terms of criminal activity started maybe 2017, 2018, the end of 2019 is when we started to see it really deteriorate insurers' profitability. And therefore, we started to see increased scrutiny, and we started to see really, really significant increase in rates. Now, ransomware, of course, is one part of the story. We also have increased frequency and severity beyond ransomware. So when we think about non-ransomware attacks that are targeted at companies, we see continued activity in terms of data breach and the theft of information. And we see emerging threats around compromising the integrity of information. Insurers have a lot to contend with. And when we think about the sort of the game that you have to play against criminals, attackers only need to be successful one time, but you as a company protecting your crown jewels have to be successful 100% of the time. And that makes it, again, a very difficult risk to underwrite completely and to provide the very broad coverage that we've become so accustomed to. And so one of the things that we're seeing, therefore, is market contraction. One of the responses to these significant changes in the way claims play out has been many markets aren't able to offer the same capacity that they used to be. And in the context of an overall insurance portfolio, we think about the capacity that cyber insurers deployed on cyber towers compared to, let's say, a property tower. They were already relatively small lines, 5 million, 10 million. So when those contract, it really makes a difference in the large towers that we're able to build for our clients. Now, this is part of a normal hard market cycle. And we think that, as new capital injects itself into the market, we will see a return of some of the capacity that we once enjoyed. But right now, this is a big challenge for a lot of our clients, is finding the capacity that we need to meet the demand. So we might know that our maximum probable loss is here, but we really can only obtain this much capacity. And I think, underlying all of these issues are also a really, really strongly increased scrutiny by cyber insurance underwriters, because ransomware is an issue, because frequency and severity beyond ransomware continue to be an issue, and because they're receiving a lot of pressure to reduce capacity. They have to think really carefully about how they underwrite and what coverage they provide. And we're going to talk a little bit about some of the specific challenges that underwriters have in terms of information and what they're looking for. But the way that this is playing out in the overall cyber insurance market, of course, pricing and terms. So rates are going up. We can get into discussions about region by region, what we're seeing in terms of rating and pricing from insurers. But our average rate increase throughout the middle of the summer is in excess of 75%, and that's the average. And so we really sympathize with you, because we know it's a very painful time to go through a cyber insurance renewal. It's very expensive. There's lots of underwriting information required. We've talked about claims. Let's talk about underwriting information. So we know that insurers experienced a dip in profitability in this area, and cyber insurance, of course, for so many insurers has been heralded as the next big organic growth area. And so we know that terms have been getting broader and broader, and pressure from brokers has allowed us to provide less and less information, while coverage has gotten broader and broader. So at the very point when a spotlight is on this line of business and profitability erodes, underwriters have to take action. And one of the first things that they can control is to do as much due diligence as they possibly can. And the other thing that they've often done, and what we're seeing right now, is they become a lot less flexible. And so one of the areas, well, I suppose there's probably 10 to 12 specific areas of risk control that most underwriters now agree affect the frequency and severity of ransomware incidents on their book of business. But many underwriters in the very beginning of this market cycle said, okay, well, these are my 27 questions that I need to ask you about ransomware, and I must have my form, and I will not be flexible at all. And obviously for you, our clients, that's a completely untenable situation. If we're approaching 7 different markets, we can't ask you to fill out 7 different questionnaires. And so we've made a lot of progress as Marsh, working together with the markets for your benefit to consolidate, to rationalize, and to bring a little bit of order to that difficult information request. But the carrier's demands for information remain really, really high, and we have to continue to be responsive to those needs. And if we hope to make it through any renewal, we have to provide really detailed information, and we have to look at how we can differentiate you. And even when we provide really good information, there are still some carriers who are far less flexible in what they can provide coverage-wise than we would hope. So how are we helping? What's Marsh doing to help you think about those controls and how you provide that information to insurers? And it's not to say that any of these particular controls are a silver bullet. So it's not that if you have multi-factor authentication and you apply it correctly for both remote access and for admins, that you suddenly don't have a ransomware risk. However, the correlation between these controls and losses that insurers have experienced is so strong that I would say everything on this page is a prerequisite to be insurable in the current market. And not only do you reduce your risk of ransomware incidents becoming a problem, but you reduce your risk of all cyber incidents, including privacy incidents, including business interruption that has nothing to do with ransomware. So these controls, I would say, are the new normal baseline that insurers expect all of their clients to meet. So, while every carrier may have a specific separate application that you need to fill out, or you may be able to provide your own evidence of the way that you execute some of these controls, one of the ways that Marsh has looked to consolidate these questions is by a very rigorous process of consulting with insurers and working to incorporate all of their information needs into our existing Marsh cyber self-assessment. So if I know that our cyber self-assessment is widely used by our clients in India, and it's built using elements from existing frameworks. The problem with those frameworks is while they're not entirely static, they're not nearly as dynamic as we needed them to be in order to fulfill insurers' information requirements. And so what we have done in the past 6 months is create a process by which we are constantly incorporating the latest information that insurers require regarding control frameworks, regarding issues like biometric information, which has become a new hot topic, regarding responses to widespread incidents that insurers want to understand your response to. And we bake all of that into our self-assessment. And while our self-assessment still provides you with a rating, which is measured against the NIST CSF functions, we also now go a step further. And if we go to the next slide, we now produce what I would call a meta-analysis of your responses to the self-assessment. And we'll look at those 12 areas of controls that insurers now feel are very specific to ransomware and required. And we'll produce a report for you that you can use to make decisions about how you want to treat your upcoming renewal in the context of your already planned investments in security, remediation tactics that you had planned to employ. And it will really help you to make a roadmap. We suggest that you look at filling out this cyber self-assessment and then analyzing the ransomware controls meta-analysis up to 6 to 8 months before your renewal, so that you can make decisions about whether you would like to invest time and effort in trying to improve some of the areas that we might flag, or go to market with a really good story about what compensating controls you have in place so that we can achieve success in the insurance market. But in any case, the way forward and the way to have success in the insurance market right now with respect to cyber is truly to differentiate. And this is one of the ways that you can prepare yourself to be differentiated in the market. Another tool that Marsh has spent quite a lot of time working on, and I might let Tom jump in and talk about this with you, is cyber risk analytics.
Sure. Thank you very much, Sarah. So I think that one of the key questions we get from clients is how do we understand the value around cyber insurance as an environment, right? If you're operating at a time where underwriting scrutiny has never been greater and the cost of insurance has continued to rise, I think a lot of clients quite rightly ask the question, what is the value of this product? What do I want to do with it? And perhaps even more fundamentally, it's understanding the overall cyber risk environment. I think the reality is that for most of our clients, they don't actually have a cyber insurance problem. What they have is a cyber risk problem, and they're using cyber insurance to solve it. So to go after that fundamental cyber risk problem, you have to understand the nature of the risk. How likely are events? What would they likely cost? And then what is the relative value of investments in additional security versus risk transfer like cyber insurance? And that's a really important question right now. I think if you look at the increasing consensus around the government response to the growing global cyber risk, increasingly there is a focus on mitigation and transfer rather than attempted cures through cybersecurity. The truth is that organizations have never spent more on cybersecurity, and yet the problem has never been worse. So growingly, there's a recognition by policymakers and business leaders that the same old solution of adding more security and throwing more money at the problem isn't going to work. And so at Marsh, and really at Marsh McLennan, we've made the decision that we want to focus on being the global leader in cyber risk analytics to help clients across this spectrum. So we started what's called the Marsh McLennan Global Cyber Risk Analytics Center, which brings together experts from Marsh, Guy Carpenter, and Oliver Wyman to bring together all of our best thinking and to really maximize our relationships into the marketplace. I think we recognize that our fundamental value to you, in addition to our internal ability to solve problems, is identifying who are the leading firms and partners globally and making sure we bring the best of that thinking to you. On this slide, you see, I think, the key areas that we're focusing on with the Cyber Risk Analytics Center, at least in the context of individual risk purchasing decisions. So first of all is this fundamental notion of understanding the different types of cyber risk your organization might face, and then trying to understand both their severity as well as their relative likelihood. One thing we know about all risk issues, but certainly cyber in particular, is that organizations usually don't have the right sense of what's most likely to occur to them, and if those things are to occur, how bad they would be. We see organizations basically chasing the wrong kinds of risk. And so there's a real opportunity to use objective, financially driven analytics to start to focus on the things that are actually disruptive to the organization. Second, then, is that economic component, looking at the cost of cyber event scenarios, breaking down the different components of loss, understanding what is actually driving the loss. As an example, organizations spend a lot of time, at least that we hear, talking about the challenge of reputational risk. But experience tells us that reputational risk is often one, a secondary consideration, and two, potentially greatly limited if organizations have a quality response. Whereas the cost of business interruption loss can be very significant, even for organizations that are ostensibly well prepared because they haven't practiced their response plan. So going through and understanding the economic cost of cyber scenarios is really critical. Then we layer on the what-if modeling to understand how different risk transfer methodologies can help improve the overall organizational risk posture. One of the things we know is that even though cyber insurance has become more expensive, it still remains pound for pound one of the most capital efficient ways for organizations to protect themselves. We use our what-if models to help organizations understand the consequence of using cyber insurance as a way to hedge against downside risk and to do that in an extremely capital efficient way. And finally, we look at the opportunity to, as we shift from a cybersecurity discussion to a cyber risk one, to move the discussion from the technical to the financial. The server room runs on ones and zeros, but the boardroom runs on economic measures. And so it's really critical that if we're going to get a consistent, comprehensive organizational view of cyber risk, that we move away from technical methodologies and understanding patch cadence or number of emails scanned, things that don't necessarily have any economic consequence, and start moving to financial terms. That's how we can bring together the CISO, the risk manager, and the senior management so that there's a consistent organizational view of risk built around the same financial metrics that drive decision-making throughout the rest of the firm. We're making investments around the globe to bring in the best data and models, as well as to do our own fundamental research and to leverage the experience we have from tools like the cyber self-assessment, as well as the unfortunate loss experience we gather as part of assisting our clients. This is a critical way that we'll be looking to add value to you through not only your immediate transaction, but in the future to help you beyond just the cyber insurance transaction, but more fundamentally thinking about how do you manage cyber risk in a dynamic environment. So we have these tools in two different formats. One is cyber insurance decision support, which is the suite of tools that we bring you as a Marsh brokerage client to help you understand cyber risk in the context of your individual insurance transaction. But we also have available on a more bespoke basis consultative services to address the broader organizational questions and to bring that to you with the best of our thinking from around the globe so that you can help the organization more fundamentally understand and reposition your comprehensive risk management program. All Marsh clients get the benefit of our analytics for their insurance transaction, but as we look at other areas like claims management, incident management, risk intelligence, or how to build a more resilient organization, we're available to provide these services on a consultative basis to help address your specific challenge or issue. So we can go through some of the individual tools. The most fundamental one, and I think that's really important, is the risk profile. This is where we take our information about you that you provide in the cyber self-assessment, and we use that to calculate the frequency and severity of various cyber losses. This is a screenshot from the tool that we actually use, and we're using some very high-level analytics to understand in real world terms, what is your 1 in 1,000, 1 in 250, 1 in 100 loss scenario, and what are the different components of that loss in terms of the economic cost. We also have our heat map of top cyber risk scenarios, where we bring together all of our inside data as well as our threat data to help you understand what are the specific types of attacks that are most likely to impact your organization. Then we can also do a comparison of the utility of various economic insurance programs, which are the ones that are going to drive the best return. Increasingly, we see organizations think about moving their retentions up so that they can manage their premium and or potentially increase limits. That's often a very effective trade to focus the cyber insurance program more on the catastrophic elements of the risk than on the frequency elements. And we use tools like this to help you through that process. And then finally, on a more consultative basis, we have our comprehensive financial stress test. This brings together all of the different tools in a highly customized format to help you understand the overall potential impact of cyber risk, not just to your insurance program, but ideally to the balance sheet, the income statement, and potentially the share price. All of those tools are available to clients around the globe. So now let's go to our second poll question. What, according to you, is the top reason organizations are purchasing cyber insurance? I feel like I should hum the theme to Jeopardy.
Great. So thank you, Tom. Thank you, Sarah. So no prizes in guessing. Largely, it's the increased priority on cybersecurity is what our clients think, clients and prospects think about it, and also the good risk management practice that cyber insurance, brings, with it. So, as they say, cyber insurance, clients should not consider it as an alternative to risk management. It is the part of the risk management altogether. So if you have it's like consider it as a fourth leg of the stool, where the three legs are the technology, processes, and governance. They provide you stability. Cyber insurance will also provide you financial stability. With this discussion, we will move on to our panel discussion. As Anup mentioned earlier, in the introduction, that we have Sarah and Tom with us, and also joining along with them, we'll have Anup to give you the Indian perspective. So we would like, while there are certain questions which our clients have asked, we'll take them along. But I would like to pose certain questions to our esteemed panelists today, and like to know from them what are their views on some of these issues which we are seeing in the last 6 to 12 months. So my question, beginning with Tom, my question will be: while we have all heard about ransomware, and there are so many discussions which we have had on ransomware, and it's done to death. Apart from that, what do you think are the top 3 or 4 critical cyber risks which the organization should be wary of? While we consider ransomware as number 1, and it keeps on changing over the years, but apart from that, what do you think are the critical risks which we can consider?
Yeah, absolutely. I think one of the things about we know from the past 20 years of cybersecurity and cyber insurance is that there are episodes or waves of different cyber risks. Today, we are in the throes of a wave of ransomware. But 6 or 7 years ago, we were very much in the similar, facing a similar challenge around payment card data, particularly in the US. 10, 15 years ago, we were dealing with unencrypted removable media. I think going forward, it's tough to know exactly what will manifest, but I think you can point to 2 or 3 mega trends that are going to be incredibly important. One is the looming threat or challenge, I should say, of the regulatory response. We're seeing that a lot right now in the US around biometric data, where there's a lot of laws that put strict controls on the collection and use of biometric data. But we've seen it recently in Europe with the GDPR. And one of the things we realize is that as technology continues to transform every element of our lives, and certainly we've seen that more in the past 2 years than at any point in probably recent history, there is inevitably going to be a lot of questions being asked by regulators on behalf of their citizens to understand how that works. So we know that both from a privacy perspective and increasingly from a security perspective, as cyber attacks proliferate, there will be quite a lot more happening in terms of regulatory response and intervention over the next couple of years. And I think it's incredibly important for organizations to recognize that they are increasingly in a global environment, potentially subject to regulatory consequences in jurisdictions where they may not have direct operations, and for elements of their business they may not have thought of. So as an example, in the US, the biometric data laws are being used to challenge organizations that use thumbprints for time cards. And so something that an organization would say, well, I don't have any biometric data. Well, if you have employees and you let them use their thumb to walk into the building, guess what? You do. And so I think that that's going to be incredibly critical. I think organizations need to keep an open mind about what the consequence of this changing dynamic regulatory environment is. Second is the question of cloud computing and hyperconnectivity. Traditional notions of cybersecurity, I think we've seen, are built around the notion of an internal perimeter to the organization and an external environment. Things are outside or in. That's really terribly outmoded. The reality is that for any organization, data and connectivity moves in and out of internal systems consistently. In fact, that was one of the things I felt a lot last year. We got a lot of questions about what does work from home mean when organizations now have all of these devices. I think that reflects an outmoded thinking that somehow being in the office is a magical talisman that protects the organization. The reality is that even when you're sitting at your desk, data is streaming out of your devices into the cloud and back and forth constantly. That hyperconnectivity is undoubtedly critical to future economic success. Just like we don't put a water wheel next to our textile mill anymore, the economic advantages of leveraging the cloud and the technological innovation of the cloud is inarguable. But the consequence of hyperconnectivity is that things become inherently more fragile and will break in ways that are not easily foreseeable. And I think that organizations really need to rethink their notions of resilience in the face of this complicated environment. Again and again, we see organizations that are supposed to be resilient to cyber events, proving that in the actual event, they've not sufficiently tested or planned for flexibility to respond. I'll give you an example. Netflix, right, which is one of the world's largest distributors of video of video and content, has an internal set of tools called the chaos monkeys. And what the chaos monkeys do is they deliberately go around and automatically and randomly turn off pieces of Netflix equipment, not only in development, but in production. And the reality is that if you're building a software at Netflix, you can't assume that anything is going to work ever. And so as a result, Netflix is incredibly resilient. If you contrast that to more traditional forms of development, organizations are constantly identifying this is critical, that's critical, this can't fail. That's going to be a huge problem. So I think rethinking our notions of uptime and focusing instead on resilience, flexibility, graceful degradation is going to be incredibly important. And as a result, organizations are going to get hit by a lot more business downtime events than they would have thought. because yes, you gain significant advantages by going to the cloud, but there's a tremendous amount of uptime or fragility in that hyper-connected environment. The third trend I would point to, and this is the one that is most remote, but I think potentially the most impactful, is this question of information integrity. There's generally three different kinds of three properties of a piece of data that you might want to protect. It's confidentiality, which is the fact that I know it and you don't, and that's basically privacy risk. There's availability, which is my ability to use it for the purpose I want. That's really uptime risk. But there's also integrity, which is the reliability and trustworthiness of that data. To date, we've really only seen a lot of attacks around the confidentiality and availability of information. But going forward, I think it's inevitable that we'll see attacks on the integrity of data. What happens when you can no longer trust your customer database or even your employee list because someone has gone in and actually, or even only potentially altered those records? How can an airline fly if the maintenance records can't be trusted? I think the flip side of the incredible proliferation of data and systems is that our confidence in that data needs to be greater than ever, and yet that confidence is potentially more fragile than ever. So looking a little bit further afield, I think it's inevitable that we will start to see attacks on the integrity of data, and those can be particularly devastating because protection of integrity is a direct challenge to confidentiality and availability.
Great points, Thomas, and one which resonates the most, with Indian clients as well as the regulatory response. Since we also are, waiting eagerly for our own personal data protection bill, which many say is just a copy-paste job of EU GDPR, because the kind of fines, penalties which are which may come on Indian clients, facing these kind of regulatory risks. Are almost similar to an EU GDPR, and a lot of things are very common. Right from keeping the data within the country, within the geography itself, or right to be forgotten. Those kind of clauses have been just copied from the EU GDPR. So yes, that's something which also keeps our Indian clients awake at night. But coming back to Sarah, you're sitting in the Mecca of insurance. Whatever happens here has already happened in London 6 months back. So what are your views? With so many attacks we are seeing in the current scenario, insurers filled with so many claims, notifications. What do you think the insurance market is looking at right now? I mean, while we understand that the limits are going down, the premiums are going up, you have already spoken about that. But any crystal ball gazing which you would like to do for the next 12 to 18 months for our clients?
Yeah, I mean, I think that the continued scrutiny of the controls that, are, we say are specific to ransomware are really about the correct, proper deployment of really basic cyber hygiene. And I think that, many organizations have been able to get by at, a high level, sort of, we bought this piece of kit, it's part of our arsenal of cybersecurity protection, but do we think thoughtfully about how to deploy it in a connected way to really protect the organization? So I think some of it is about that second level down of, no, but how do you deploy that? Really double checking. And I think that the fact that insurers are applying more scrutiny on all levels is a great thing for our clients, because it should create that virtuous cycle of investigation of risk management techniques, incentive to invest in those risk management techniques, and protection if the very worst case happens and your several lines of defense do fail. So I think we're going to see continued diligence and scrutiny, just like we have seen. And I think we'll see another layer on top of that, which is increased use of technology and automation in the underwriting process. So right now we rely almost entirely on information that our clients provide about themselves, the self-assessment. There's not really a true audit in the insurance process generally. And as cyber insurance continues to scale, and as we put more and more premium into the market, policy counts increase, insurers need to find ways of increasing the automation in that underwriting process in a way that's reliable and in a way that layers on top of tell us about yourselves and then we'll make a decision. Because when if we have to have, 700 emails back and forth to get to the right answer, not very efficient. And if we can find reliable ways to do outside-in scanning, or even beyond outside-in vulnerability scanning, if we can find ways to connect insurers to data feeds within an organization, AIG's made attempts to, pull some information out of Darktrace, for example. I think we'll see more and more connectivity and partnership there to, put eyes inside an organization for the purpose of extracting some of that information about a client in order to, whether that, I don't know that dynamic underwriting and dynamic pricing is on the way for cyber insurance just yet, but I think that more and more of that will continue to occur, as well as more automated decision making. We've seen the first digital syndicate that is doing totally algorithmic underwriting in London for cyber insurance as one of the lines they're looking at. I think we might see more and more of that automated decision making as well, particularly in maybe the more predictable middle market or SME segment. And then I think looking, well, not that far forward, maybe right now, but also in the next 12 months, we're starting to see a renewed appreciation of the systemic nature of cyber risk. And we're seeing that play out in insurers becoming more and more concerned about the aggregation across common vendors, whether those are cloud service providers, who are well known to everyone, or even more niche, and also the potentially systemic nature of common vulnerabilities in frequently used software. And I think that there's a confluence there of that type of systemic risk that relates to third parties, and also the constant specter of nation state attacks that could have a systemic impact on a particular geography or a particular industry. And so I think we'll see, and we're already starting to see, some insurers rethink their approach, and whether that means they need to look at different reinsurance structures or alternative capital to help them to support the coverage and the scope that they already provide, or if unfortunately that means much greater and more specific underwriting scrutiny on that topic and restrictions in coverage for events that affect multiple insureds across a portfolio. I think we'll see all of those approaches in the next 12 months. And that's another thing that Marsh has been very proactive about. We're actively working on how we can help our clients get prepared for and advocate on your behalf to get the best results in the face of markets making some of those changes.
Thank you, Sarah, and very good points again. And some of these things which we have started seeing in India as well. That some of our insurers have tied up with third-party cybersecurity vendors, and they are evaluating our clients or prospects with third-party maturity reports which they're collecting. Like AIG is partnered with BitSight in India. Again, Marsh has a tie-up, with BitSight, and we do help our clients coming up with their cybersecurity maturity. But I would like to ask you, this question specifically, since we are seeing so many claims, in India in the last 6 to 12 months, and many of clients, and market has seen so many claims. Insurers are flooded with these kind of scenarios. What are the common issues which you have seen, clients facing when they are saddled with a claim? What are the common mistakes which you have seen clients making in these kind of claims, which basically, and then they struggle getting their claim out? Any inputs on those?
Yeah, sure. Thank you, Bhishma, for that thing. And yes, as they say, in hindsight, we are all experts. So we do have a bit of a hindsight now. I think there's a significant amount of claims activity in the last 18 months, 24 months, for sure. So 5 or 6 quick points from my side, what we have seen in India. One is a lot of clients have never done a dry run. Like what Tom was mentioning, there's certainly no chaos monkey, but they've not done a dry run when things go wrong, who will do what. We recently had a cyber claim where the client's corporate email was frozen up and the client was unable to send emails as well. And that's got settled. Thankfully, all is well that ends well. But that was something that is number one, that gather your facts well, do a dry run. Probably you should know who will do what. Point number one. Point number two is a lot of time is usually spent, and this is much more pronounced when it comes to traditional brick and mortar companies who have a breach, and maybe a public sector or state-owned company, on who will be the security team, who will negotiate with the threat actor and all. If you can, and use a service provider like maybe an insurer who has a tie-up with forensics or with some negotiating entity which can talk to the threat actors. But if not, at least do some kind of best friend arrangement. So a lot of time is usually lost, precious time. We recently had an issue for a breach incident. The threat actor was asking for 200 Bitcoin. The company was willing to give them 8 Bitcoin. The insurance company was even unwilling to give them 2 Bitcoin, and eventually 13 terabytes of data got leaked to the public in the public domain. So that's point number 2. Point number 3 is when insureds incur forensic cost or other expenses, you need to tell your insurance companies about that. And you may have the best placed policy, all singing, all dancing, emergency cost, and all sorts of stuff inside it. It's important that you start telling your insurance company what you're spending, where you're spending. We recently had a breach incident, very large household name in India. They spent $5 or $6 million. They did not, and they had a pretty sophisticated policy. They did not inform the insurance company. Insurance company put a massive haircut, only paid them $1 million of claim. So please do inform them. Please do keep your insurance company updated. Point number 3. Point number 4 is, in India, we also learn seemingly informing Certain, which is the emergency response team in India, is mandated by some insurers. Now, Certain does not mandate that if you get breached, you need to update me. But some insurers say, have you updated them? So I think some of those best practices, or like I said, the hindsight approach, talk to your broker, talk to your risk advisor. I think these are some of the check in the boxes that the insurance companies would like, although they are not mandatory. So that's point number 4. Second last point from my side is provide complete and accurate information and in a timely fashion. So this is, I believe, a repeat of point number 3, that sometimes there are too many moving parts. The absolute worst thing is that for you to have 5 forensic firms or people working with you who are duplicating work effort, and at the end of the day, you take a big fat bill to the insurance company and they say, hey, you know what, this half of it is duplicate work. We will not pay you. So that usually ends up in tears always. And last but not the least from my side is that, use a good service provider. And I'm not talking only from a broker perspective, but, agree on a pre-agreed panel with your insurance company. If nothing else, even if you don't get an immediate service, at least you'll get negotiated rates, like Sarah was mentioning and Tom was mentioning. You'll at least get some access to the same service providers. In any case, they have few, you can count them on the fingers of your 2 hands. You'll probably get through the insurance company route access on preferential rates. That's expected. So that's all from my side. Vishwan.
Thank you, Anup. So valid points. In short, what you said is be prepared. You will ultimately get hacked, but once who comes back remains in the race. So yes, that's a valid point. And while we are on the subject of claims, we have a couple of questions from our from our audience as well on ransomware claims. And Sarah and Tom, I would like to ask you this question as to the legality of ransomware is definitely in question. Some of the countries have come out and said that they won't allow ransomware payments to be legal. AXA in France is saying that they will not issue any policy with ransomware payment inbuilt in it. So they are basically excluding ransom coverage. What are your views, Tom? What's happening in US around some of these issues? Sarah, what's the reinsurers and insurers take in London? So who wants to go first?
It's a great question, Bishma. I think that first you have to understand the different components of what we're talking about, and then we can talk about the perspective. So when it comes to the legality of ransomware payments, the underlying issue is the legality of the client paying the threat actor. And generally, there are 2 different issues here. One is whether it is legal in a given jurisdiction to pay ransoms at all. In some locations, there is a question of public policy where the payment of any ransom is illegal. And so ransomware is not some kind of special ransom. You can't pay ransoms anywhere. That varies country by country. And obviously, if it's illegal to pay a ransom, then it's illegal to recover the ransom under insurance, because the underlying act is illegal and you can't insure illegal acts. The second question, and the one that is perhaps more impactful globally, is that many times the threat actors or the people who are launching the ransomware attack may be viewed by one or more governments as terrorists or some other sort of criminal organization. This is done most frequently in the US via the Department of the Treasury's Office of Foreign Asset Control, and OFAC for short. And so what OFAC has is a list of specially designated entities with whom it is illegal for American institutions to transact business. And so as a result, not only that is what we call then the sanctions issue, where paying of a ransom, right? If you get ransomed by your neighbor, that might be legal. But if your neighbor is an international war criminal, then even if you could pay them a ransom, it's illegal under these sanctions laws. The complexity of the sanctions issue is one, it's not always quite clear who the threat actor is. So whether or not you're attempting to pay a specially designated entity or similarly sanctions controlled entity is not always clear. And in fact, the threat actors often will use cryptocurrency or other means to try to obscure who they are to get around the sanctions issue. So there's one issue, which is, who is this person? Are they a specially designated entity? And how long does it take to make that determination? Sometimes the client wants to make that determination quickly, but the insurer wants to take their time. But regardless, if it turns out that the threat actor is a specially designated entity, then any organization which falls afoul of those sanctions is prohibited from making the payment. So your local organization may be able to make the payment, may not be subject to sanctions, but the insurer or the bank or the law firm or the accountancy or the company that sells you the stamp to mail the letter could all be subject to sanctions. And as a result, they cannot assist you. As an example, we at Marsh McLennan, if the payment is being made to a specially designated entity, we can't assist because it's illegal under US law. This is similar to a lot of foreign corrupt practice laws. The UK has a similar law. So these are the same kind of issues where the conduct, anybody who's attached to the transaction is prohibited. So it's really a two-part test, which is one, is it legal in the jurisdiction to make a payment, period? And then two, is the person whom you're paying a sanctioned entity? Those are the two issues. The third then becomes this question of, and this almost goes back to the first, is payment of ransoms accelerating ransomware? To me, I think that's the easiest question, even though it's not necessarily a popular one. The answer is no, because people are running ransomware attacks because they work and they drive value. And many organizations still don't have insurance and they get attacked anyway. The truth is that if we think about the underwriting scrutiny that clients are going through and the increase in price that clients are receiving, which is a very strong signal about the rising threat of ransomware, it's clear that organizations are potentially much greater beneficiaries of cyber insurance and that ransomware should be allowed. But the underlying question of whether ransomware should be insurable, but the underlying question of whether or not ransom should be paid or entities should be sanctioned, I don't think is one for the insurance industry to solve. We're just a mirror telling organizations what's going on. I think in addition to the fundamental question of coverage for ransomware payments, one thing that's really important is making sure that if your policy doesn't cover ransomware payments, that it still responds to ransomware attacks. You could still have a business interruption loss. You could still have expensive forensic costs. You could spend a lot of money even if you don't pay the ransom. And it's important that even if your policy, for whatever reason, doesn't cover ransomware payments, that it continues to extend coverage for the other elements of ransomware. That's one of the things we're extremely vigilant about in our diligence process, is making sure that clients understand exactly what is and isn't covered and why they may want to forego ransomware payments, but probably do not want to forego coverage for ransomware.
Thank you, Tom. So Sarah, what are your views? What are the insurers, talking about ransomware payments in London?
Yeah, I mean, I think that was a pretty comprehensive view. Two things I guess I would add to that. One, I completely agree with Tom on the topic of on most topics, but on this topic in particular, does cyber insurance fuel ransomware growth? Absolutely not. I mean, I think you could make strongly the opposite argument, in that if an entity has cyber insurance, they're insured for the potentially devastating business interruption that follows not paying a ransom. So their incentive is much more about, how do I recover my business? How do I get back on track? And all of that's paid for. I'm supported by an insurer. I have the ability to not take that sanctions risk and not take the reputational risk of potentially funding terrorism. I have the ability to have resilience because I have cyber insurance. So I think there's a much greater motivation for organizations that have cyber insurance not to pay versus to pay. And then, looking at the way insurers have approached this, almost universally, the feedback we've had is that the way insurers would like to deal with ransomware from a coverage and an underwriting perspective is to apply more underwriting due diligence, to potentially use sublimits and some restrictive language, but not to fully eliminate coverage for ransomware payments or for ransomware attacks that cause other impacts that are covered in a policy. And you referenced, Bishma, the decision of AXA in France. And what I thought was really interesting, because that got a lot of press. And what's really interesting there is that AXA in France specifically, actually they had a long-standing appetite not to cover ransoms in any kind of policy. So they don't touch, K&R, they never provided the cyber extortion component of cyber insurance coverage. Now, when the market was a little bit softer, they got, just like everyone else in the market, sort of pressured into expanding cover. One of the things they started to expand into in 2020 was covering ransomware. And then very quickly, as the market changed, they made this public announcement that they weren't doing it. But actually, in the context of the overall market, that was a very short dip our toe in the water and then we're back out from one insurer in one country. And we have not seen any sweeping retraction of overall appetite to cover ransomware. Many more insurers have told us that they will simply wait to see what public policy evolves on this topic. And then obviously they'll need to be compliant with that in terms of what they can cover and what claims they can pay.
Yes, absolutely, Sarah. What we are seeing in the Indian market is very similar. Insurers are waiting and watching. Some of the insurers, the big ones, have started putting restrictions on ransomware payment. They've started, building in co-pays when it comes to ransomware, sublimiting as a cover. So yes, it's a concerning factor for our clients, and that's where our advice would be that there's never a right time to buy cyber insurance, but if it ever be, this is the time we should all should look at the cover. I think we are almost reaching the end of our discussions today, but my last question to all three of you would be, any advices would you like to give, quick advice to our clients who are looking at renewing their covers, or some prospects who are looking at buying the cover for the first time? Quick one, starting with Thomas.
Yeah, I think this is an important issue. I mean, I think it's important that clients continue to dig into it. I know things are going to continue to evolve and change. I think that the key thing is to recognize that overall, the value proposition of cyber insurance has never been stronger. Yes, prices are going up, but the prices are going up because the risk is becoming greater. I think the challenge that clients will face and that we'll assume is to continue to drive the connectivity between the underwriting and the outcomes. You know, we want clients to see that the improvements they make a difference. Although the challenge is that right now the standards have never been higher. It's a dynamic environment and clients need to be responsive. So I think it's a very challenging and unfortunate time for clients, but it's also a very exciting one. And there's a lot more great things to come for the market.
Absolutely. Sarah, your quick thoughts?
Yeah, I think the number one thing that I would tell clients preparing to either approach the cyber insurance market or to renew your cyber insurance policy is plan to differentiate yourselves and spend the time up front to critically examine what your real state of play is. Leave no stone unturned before you approach the market. One of the impacts of the difficulties in the market right now is that underwriters have more on their plate than ever. So the more efficiency that we can bring them, if we bring a clean submission that pre-answers all the questions, if we know there's going to be an issue with one of the controls that you maybe don't have deployed in the way you'd like to, we need to weave the right story about why that is how it is, what's the timeline for remediation, so that you can truly differentiate yourself as a prepared client who cares about this topic and who has invested time thinking about how you communicate it. You will get better attention, you will get more attention, and you will ultimately get better and quicker results.
Great points. Anup, any parting thoughts?
Sure. Sure, I totally agree with what Sarah is saying. Differentiate, differentiate, differentiate. Be patient with the proposal forms. There are different shapes and sizes which come. Answer specific questions. Do a roadshow. Engage insurers on a call. Sarah is absolutely right. There's more demand than supply. If possible, if your org structure allows, if your organization ethos allows, appoint one broker. You'll probably do the same thing in an IPO. You'll do the same thing in any other book building exercise. So do that. Try to receive your first cut quote with 15 days, 20 days, 30 days before the renewal. Start 3 or 4 months in advance. If you get more than 3 quotes, you're absolutely in a lucky spot. And bind early. You know what? It helps you to build and have a better negotiation with the excess company, with the excess participants, excess tower. Sarah, Tom did mention about extortion, cyber extortion, ransom issues, cyber terrorism. They did mention about state-sponsored action and all. A lot of insurers today are trying their luck by trying to sublimit some of these covers, trying to impose a COVID exclusion or a pandemic exclusion, trying to say that we will halve your extortion limits or whatever. Push back hard. And if you have time, if you've started your process in time, you will have the time to push back hard. So thankfully, this point of time, what we are seeing in India is insurers are trying their luck, but they will budge at the end of the day. But for clients who've not started in time, who have a gun to the head, who have a burning timeline ahead of them, they usually get the short end of the stick. So those are a few thoughts from my side. Back to you, Bhishma.
Thank you, Anup. So what I can conclude is what you guys are saying is quality of submission matters. More information will help our clients to get better results, and obviously the quality of vendor you select, quality of insurer you select will also matter in all these scenarios. So with this, we are on the end of our webinar today. It has been a lovely discussion. Thank you, Tom. Thank you, Sarah, for your time. Thank you, Anup, for joining us. And thank you, the audience. You have been lovely this evening. And we'll see you again. We'll see you again with another one. Thank you all.
Thank you, everyone. Have a good evening.